Now, your colleagues in the I guess money world talk to us about, we've had just the last quarter or the last month a little tick up in that inflation thing, and we're not likely to get a Christmas present from the RBA this year. Maybe can you talk a little bit about what you're seeing out there on that inflation front, the employment front, any little updatey things for us?
Yeah, sure. So our guys are like May at the earliest, probably one cut next year.
Next year.
One. Yeah, it's changed dramatically, right? Everyone's forecasts have really had to shift, and it'll be the unemployment figure, I think, that shakes it out and is the bigger concern. You need to see a real collapse, but we've got really aggressive population growth at the moment, and unemployment's still relatively low. It's when that changes that things start getting interesting. So they are moving to I'm going to get into the boring data. So, we've got quarterly CPI. There's monthly CPI, but it's not a holistic basket. It's sort of overweight goods and underweight services. So you always end up with a sort of a wonky read mid-quarter, if that makes sense. Yes. So you think you're getting it, and then you get to the end of the quarter and you're like, oh, no, that's not what we saw. So we were closer than consensus to the quarterly CPI. Everyone was out by a really big margin because your monthly reads are not that great. But they're going to move to a monthly read that is the whole basket. And so we will have better, and the RBA will have better quality data to read what's going on.
Was that a bullish shake-up, or was it
I'm not sure. They may have been working on it for a long time.
Yeah.
I mean, it was pretty shameful that we were pretty much the only country in the world that didn't have monthly CPI. Yeah. And they had to cobble something together. Although I've made this comment before, like you and I are not new to this. I did economics at university. We didn't talk about inflation for 2 decades. Like we just never talked about it. It was 2 seconds on the news, CPI's come out, it's the same, let's move on.
You probably, when you're in uni, I don't want to stamp an age on you. We would have come out of probably the 17s and back to normal. So it was probably like no problem here.
Yeah. It was in the 2 to 3% band at all times. It never changed. And it was only COVID where you're like, oh, thank God, I spent 4 years learning about this bloody thing and now I can talk about it. Yeah. But it was, it didn't really matter that there was only quarterly CPI data because it didn't really shift much. And then they had to move to monthly, and now they're moving to quality monthly. And that might change things a little bit just because the data set is more relevant.
I find it interesting that it's such a clickbaity, newsy thing because, a lot of people's mortgage, like floating mortgage rate, is probably 5.5%-ish. That's still pretty cheap money for a mortgage by normal standards anyway, isn't it?
It's incredibly cheap by historical standards, but it's the size of the debt that matters, right?
Yeah.
If you've got $1 million mortgage.
Yeah, I guess the mortgages are bigger at the moment.
Huge. Like absolutely huge.
Was it a meme, or is Trump talking about 50-year mortgages?
Yeah, no, he legitimately is
was?
talking. Yeah, now they're talking about 15-year car loans as well. Have you seen that one?
Oh, God, shoot me.
I know.
Can you shoot me?
I'd rather not, but
Yeah.
Yeah, 50-year mortgages and 15-year car loans. So what is making people like me and people who've been around doing this for a little while so anxious is this is the stuff that started pre-GFC. As soon as you start extending loan terms, it's some of the stuff that's, if you want to get into other asset classes, private credit started to become problematic. And one of the things you see when you look into these debt portfolios, as soon as people start extending loan terms, like the amount of time you've got to pay it back, that is a very good sign that you've got borrower stress, like real borrower stress. And you've now got the president of the USA say, get yourself some stress, you'll be fine.
Because, you get a 30-year mortgage at the moment, 10 years ago when they announced the 30-year or 15, whatever it was, that was like, oh my gosh, a 30-year mortgage, not 25.
Yeah. The average age of house purchase in the US now is 61. Not
It'd have
first
to be
purchase.
Late 30s in Australia, would it?
It's increasing over time. I don't know what the exact data here is. First home buyers in the US are in their 40s now. and average age of any house purchase is in their 60s. Like, it's just extraordinary. So the idea of a 50-year mortgage when you're in your 60s or in your 40s for that matter, like their life expectancies are substantially lower than here. It's wild. Like, the maths doesn't work.
Well, and that's it. Like, the debt's increasing, wages aren't really, and the only lever that society's put on, the banks would love it. Obviously not your bank, because they're,
we would not love it. We're very caring about our customers. Thank you.
Yeah. But it's just
interestingly enough,
that whole car yard thing. It's like, hey, do you want this new car? Oh no, we can't afford $1,000 a month. And the car yard salesperson's like, or the business manager, well, we could get this down to $800 a month. Sweet. Increase it to 7 years. What could go wrong? Like, it's just kicking the can down the road.
I don't work in the lending part of the business, obviously, but lending standards are such that if you are going to be retired before the end of the loan term, that's the end of your loan term, is when your retirement age is, right? So for a person in their 50s currently, it's extremely difficult to get a loan. And as first home buyers age, or the age of becoming a first home buyer increases, let's put it that way, the idea that we're going to have 50-year mortgages here just doesn't make any sense to me. I just don't think lending standards would permit it.
No.
And there's an increasing issue of people using superannuation to pay off their mortgage. That has been happening more and more over more than a decade. That's a pre-COVID phenomenon. It was picked up in the Hilda survey years ago. And also the fixed rate mortgage scenario in the US is very different, right? So you can...
Well, that's why Australian banks are so profitable, right? Because it's all floating rate, basically.
It is, yeah. But I will say also it makes Australia's banks more resilient, which is important.
Yeah, because they're not carrying the bag for millions of people.
Yeah. And it matters from an economic perspective. Like, the whole economy benefits from that. It is fascinating to me that any first world country would have fixed rate mortgages of 30 years and still have them and not have moved to variable. And you can see the dislocation. We're getting into all sorts of topics. You can see the dislocation in the US housing market now of people who will not sell because they've got a 2.5% mortgage.
Yeah, and 100%.
So that's it. You've got this massive issue of people who won't sell.
They're in mortgage prison, but a good kind that's good for the money but bad for lifestyle.
Bad for lifestyle, bad for where they live. It's massively reducing mobility. So you've got huge issues with new housing coming online and not selling because no one will sell their old ones and move into the new. It's doing very weird things. In that period of obviously ultra low rates threw things out all over the place, but particularly in places where you could lock them in for 30 years.
Yeah. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.